no way to know, right? So I want to talk to you today about how to own a sacred account in your 401k. So if you have an old 401k, you can also do this with a traditional IRA as well, or any other qualified retirement plan. The only thing you can't do it with is a native Roth IRA, one that you've contributed to from your own income, I mean, basically just one you've contributed to from your own income. You can't do it with that. But if you have one of the other types of plans, what you can do is you can take that money and roll it into a qualified plan trust. It's self-directed. It's called a self-directed retirement plan, for short. And basically what you're going to do with that is that money is now self-directed. There's no custodian. You are the custodian. There's no third-party administrator. That's you. There is no Wall Street involved. There's no asset manager involved. It's essentially like a qualified plan. It's still a 401k, but it's 100% entirely self-directed. Meaning you're not paying management fees. You're not paying any of that bull crap. You have access to your money. Now, it still applies as a 401k, so you got to follow the rules. But once you set your account up this way, you can actually own a sacred account in your 401k. And I want to walk you through how that works. So the Internal Revenue Code says that with a qualified plan trust or a qualified plan, you can own up to 49% of your balance at any time in a sacred account. Okay, and again, that's high early cash value, dividend paying whole life insurance. So let's say you have 100 grand, right? Just for easy math, you got 100 grand and you're gonna roll that over, put that into your new self-directed retirement plan, and you're gonna invest that into a sacred account. You can take 49% of that. Okay, so that's going to be $49,000, and you're going to put that into what's called a MEC. And a MEC it stands for a modified endowment contract. Don't even worry about the vocabulary on this. Basically, you've got your life insurance. You can do a high early cash value, and then essentially there's a line you can't cross called the MEC line. And the MEC line basically is where the IRS is going to try and tax the policy because you put in too much money. Well, check this out. If you cross the MEC line, the policy grows faster and you get more liquidity. So from that standpoint, it's attractive. From the taxable standpoint, it's not. But your policy is owned by a 401k. And guess what can't happen to a 401k? A 401k can't be taxed. So what that means is we can MEC the policy on purpose, meaning we can cross the threshold on purpose, knowing that the IRS can't tax that money anyways because it's owned by a 401k. And you now own a MEC. The benefit of a MEC is you're earning 6 to 8% annual gross dividends each year on that money. Inside the 401k, you can pull the money out of the MEC. It's still tax sheltered in the 401k, still earn the 6 to 8%, and then go buy real estate with it. Think about that. So if you're earning 6 to 8% on your money from that sacred account in the 401k, you borrow against it, simultaneously still making 6 to 8, and then you go invest in a real estate deal that's paying you anywhere from 8 to 12. Add that up. That's a serious rate of return inside your 401k. The best part, there's no volatility. There's no ups and downs with the stock market. My clients that I'm doing this with last year, you guys remember December when the S&P tanked? My clients lost nothing. In fact, I have a client who did have a deal that didn't go the way we planned it, right? And basically, she's making more money because of the way that we structured the deal. So in a best case scenario, she's making good money. In a worst case scenario, she's making even more money than she made in a best case scenario because we have control of the investment. So if you have an old 401k plan, you got to have at least $50,000 to do a real estate deal. So if you've got at least $50,000 in an old 401k plan, from an old employer is just sitting there, or maybe you rolled it into a Roth IRA and gave it to a financial advisor who's going to go peddle it on Wall Street, and you would rather have control of that money, you would rather eliminate the fees, you would rather eliminate volatility, and you would like to see how you can own a sacred account inside that 401k plan, what I want you to do is I want you to click on the link in the comments. Okay, it's sacredaccount.com. And this is going to be a page that's going to give you a ton of information on the Sacred Account. You'll have the ability to learn everything you'd like to learn about it. And at the point where you feel good enough where you want to reach out and get more information from my team, you can do that. We'll answer all your questions. Okay, and our goal is not to sell you something and trick you into buying something you don't need. Our goal is to look at your numbers, and if we can help you, then we're going to be able to show you that with numbers and math. And that's the benefit. Math is math. If we tell you 2 + 2 = 6, you know we're lying. If we can show you 2 + 2 = 4, and we have a better way of getting you there, than you're currently doing, then you know we can help you. All right. So guys, check that link out, sacredaccount.com, sacredaccount.com. Make sure you like, share, and subscribe. I'll talk to you guys next time.